welcome everybody. I'm Tony Young. I'm a chartered accountant. I run my own small practice. So most of my clients are sole traders or operate through a limited company. If anyone wants to switch their camera on, please feel free. It's nice to get some feedback. And if you have any questions during the talk, then please feel free to ask them or put it in the chat box, whichever you're more comfortable with. So today we're covering business structures. So if you're running your own business, how should you structure your trade? Do you want to be a sole trader or a limited company? And I'm talking about the tax rules and guidance for the UK at the moment. So it's comparing the two different ways of trading, sole trader or limited company. And just to clarify, some people refer to sole trader as being self-employed. That's the same thing. So we're looking at these two different options that you have if you're starting your own business or if you're already running your own business. Okay, so which business structure? An overview. When you run a business in the UK, this can be as a sole trader, a partnership, a company, or a limited liability partnership. Today we're covering two of those main aspects, so sole trader or self-employed, and a company. A partnership is similar to a sole trader where you have more than one person, and a limited liability partnership is a special type of company, which we won't cover today. Now, companies are different to the other business structures that I referred to above, the sole trader, the partnership, or the limited liability partnership, because they pay a different kind of tax. They pay what we call corporation tax. If you're trading in any of the other structures, you pay income tax. So we have income tax for individuals and sole traders, and we have corporation tax for companies. And that creates a difference in terms of how much tax you're going to pay when you're running your own business. So sole traders and partnerships and limited liability partnerships pay, as I said, income tax, and they also pay national insurance. And there's different types of national insurance, and very often the national insurance is what makes it sometimes more tax efficient to trade as a company. Companies are separate legal entities from the individual, whereas a sole trader business is taxed as part of your individual tax return. And that's what I always try to get clients to understand, that if you're trading as a sole trader, your income tax is, you and the business are the same person. So everything goes onto your personal tax return, and you may have different sources of income. That's something we've covered in other talks. But there's just one return for your personal tax return. When you trade through a company, you create a separate legal entity, and that company, even though you may own the company, is a separate entity from yourself. It's very important to keep that point in mind and to understand that. The reason for that is that the company's money does not belong to you as an individual, even though you own the company. So points to consider when choosing a business structure. One of the main reasons for choosing to trade as a limited company, other than tax reasons, is to limit your liability. And this can also be achieved via an LLP, limited liability partnership. So what that means is that if there's some sort of problem where a customer wanted to sue you, they'd be suing the company and not you. And that's quite often why people want to start companies rather than trading as a sole trader. One of the other reasons that you might want to choose a company is where you've got multiple people involved with the business. And so it's a way of splitting the profits between you, because you might have a number of shareholders in the company. But where we're talking about a single person trader, one or sometimes two, maybe a husband and wife, but focusing on the one person trader, the decision is usually because of tax savings. So the decision to trade as a company rather than a sole trader will normally be because you want to save tax. As a guide, and this is what I advise clients, is that where your profits, and I'm talking about profits rather than income, your profits regularly exceed £30,000 per annum, then it will be more tax efficient for you to trade as a company. So often startup, I would say, start as a sole trader, where you start to make regular profits over 30,000. Look at a company, unless you've got some other reasons that you need to trade as a company, such as needing to limit your liability, needing to split the profits with other people. And there's one other reason, is some clients who work through agencies find that the agency insists that they trade via a limited company. So that could be another reason. So let's have a look at companies. Companies have to pay corporation tax on their profits. Corporation tax currently is 19% if the company profits are up to £50,000 per annum. Companies whose profits are over £250,000, it's 25%, and those that have profits between 50 and 250 pay 19% for the first 50, and then 26.5% for the marginal bit over 50. So for most small clients, we're looking at 19%, which is comparable to the income tax rate of 20%. So you might think, okay, well, where's the saving coming in? And we'll talk about that in a minute. If you trade via a company, the profits of the business belong to the company. And what that means is that you must always keep adequate funds in the company to meet the company's liabilities. I find I have some clients who've run into problems where they take too much money out of the company, and then the company can't meet its liabilities. It can't pay its corporation tax, its VAT, if that's relevant, or its employer taxes. So the director and the shareholder must only take out from the company as dividend what is available after paying the company's liabilities. And I've covered that. So funds are extracted from the company after meeting its liabilities, and funds can be paid to the director shareholder by salary or dividend. Did somebody have a question? No. Okay. As an individual, you are then taxed via self-assessment on your salaries and dividends that come from the company. So you've got these sort of two things running at once, where you have a company, you've got your individual tax, and you have the company tax. But as I said in the previous slide, where your company is making profits over 30,000, it will be tax efficient to trade via company. So let's have a little look now at sole traders. So when you're trading as a sole trader, you pay income tax and national insurance on your profits. After using up your personal allowance, so the first 12,570 profit, you don't pay any tax on. Over and above that, you pay 20%. And that's up to 50,570 when the rate increases to 40%, the higher rate. There are some differences in the rates in Scotland and Wales, but these are the English tax rates that I'm referring to. But the differences are quite minor. Now, in addition to income tax, and this is where the saving arises by having a company. So in addition to your income tax, you have to pay national insurance. Firstly, Class 2 national insurance, and that's a set rate of £3.45 a week. You have to pay that where your profits exceed the personal allowance. If the profits are below that, you don't have to pay that set amount, but you still get credits to your state pension and other state benefits. If your profits are below 6,725, you don't get credit automatically, but you can choose to pay this Class 2 voluntarily, which can be beneficial. Now coming to Class 4. Now this is the tax or national insurance aspect that often is the reason that a company is more tax efficient. So sole traders have to pay Class 4 national insurance at 9% on profits over 12,570, and then 2% over 50,270. So that is generally the reason that a company can be more tax efficient, because the company is paying tax at 19%, the individual is paying tax at 20%, and then also there's 9% class 4, and it's that class 4 that you get the saving on by trading as a company. So tax comparison. So looking at around £20,000 tax saving is quite small. It's only £50 per annum, and you would have additional administrative costs by running a company. So that's why at 20,000 annual profits, I don't recommend setting up a limited company. And where we're going up to about 30,000, the tax saving goes up to around £500, and at that point, it's sort of neutral. So you probably have up to £500 of additional costs. So I'd say it's neutral. And then as you go up to 50,000, the tax saving rises to just below £1,500. So at that point, you can see it's quite significant, and you would really probably want to trade as a limited company. Another issue to consider, especially when you're starting a new business, is that if you make losses as a sole trader, these can be offset against your other income. And so sometimes you may find that in the first early years of trade, it's better to be a loss-making sole trader. And then you can do what's called incorporate the business and change it from a sole trader to a limited company. If you start off straight in a company and make losses, then those can only be carried forward and set off against future profits. So if you don't ever make enough profits, you may never get the benefit of those losses. So for that reason, it's often advisable to start a business as a sole trader and incorporate the business into a company at a later date when the profits are higher. And again, that's from a tax point of view. You may have other reasons for trading as a limited company. So looking at that specifically limited liability, we talked about that. As a company, the liability is limited to the nominal value of the shares. So when you set a company up, it would normally be in between £1 and £1,000, depending on how you structure the shares. So it's quite a limited value that the director is liable for. The exception to that would be if the director had given personal guarantees, which is sometimes required for loans. But if that's not the case, then if the company becomes insolvent and cannot pay its debts, the director is not personally liable. If a company does become insolvent, then it is the responsibility of the directors to make sure it ceases trading and does not continue to incur debts. So it's quite important for a director of a company to be aware of their responsibilities. Other reasons for trading as a limited company. I covered this briefly before. Some employers or agencies will insist that as a contractor you trade via a limited company. The reason for this is that IR35 legislation, which ensures that tax is not avoided by disguising employees as self-employed contractors. Where an IR35 liability arises, this would fall on the employer if the contractor was self-employed. Whereas if a contractor is employed via their own limited company, it's the limited company that has to pay the taxes due. That's quite a complicated point, but it's the reason why agencies insist that contractors trade via a limited company. Another reason that companies trade as a limited, that you want to trade as a limited company is if you've got multiple people running a business together. And in those cases, your options are a partnership, an LLP, or a company. So you need to consider how the profits are going to be shared and whether they're going to be shared in equal proportions, as well as the taxation of the different entities. But quite often a company is a good solution for that situation. So looking now at the administration of company, I said there is some administration involved. It is a bit more complicated. You've got a separate entity that exists legally. So once you set up a company at Companies House, all companies, trading or not, have to file accounts annually with Companies House. And they also have to file what's called a confirmation statement. This is a form basically with company standing data, along with an annual filing fee of £13. So all companies must file that annually, as well as their accounts. So trading companies, as well as the filing of the accounts and the confirmation statement with Companies House, also have to file full accounts with HMRC, along with their corporation tax return. And you need to have specialist software to prepare these accounts and tax returns. And so therefore, you generally need to pay an accountant to do this for you. Your only other option is to get some the special access to the software yourself. So I recommend, with a sole trader, people can do their own tax returns if they choose to, but with a company, I would say you're better to use an accountant. The accounting fees for a company start at around £400 per annum. As well as the company tax return, all company directors have to file a personal tax return showing their salary and dividends from the company. The comparison to that is for the sole trader. They are not required to file any accounts, and they only have to file the personal tax return. So the administration is easier and cheaper. Now I'm going to take a look now at salaries and dividends from a company. When you're a sole trader, you can take funds directly from the business. You just need to remember to keep aside enough to pay your tax and national insurance. Some clients like to keep a separate tax savings account for this, which is a good idea. When you trade via a company, it's a much more formal process. The company has to register as an employer if it pays salaries over the lower earnings limit, which is £533 per month. I recommend directors take a salary of £758 per month, as at this level, there's no employer or employee national insurance due. But the director still gets state pension credits and entitlement to state benefits. There is another option that's come in this year where directors can take a slightly higher salary to use up the whole personal allowance. And in that case, the company pays a small amount of employers' national insurance. And that applies for a sole director company. If there's more than one employee, then the company can claim the employment allowance. And at that level, there's no employer's national insurance due. So again, this is quite complicated, but the basic point is that as a director, you'll be receiving a salary and there's a certain amount of administration attached to that. As an employer, the company has to make monthly submissions to HMRC to record the director's salary via a payroll system. So if you have an online system, you can do that yourself. Or if you're using an accountant, then that will often be part of the service that they will submit the director's salaries monthly. So this is a sort of one of the complexities of running a company. Once the company has paid the director's salary and any of its costs, what it's left with is its taxable profit. So we then work out how much corporation tax that starts at 19%, is due. And after deducting that, we are left with what we call distributable profits. And this is the amount that the shareholders of the company, who may be the same person or persons as directors, can take out as dividends. The directors are then taxed on their salary plus their dividends. Because dividends are only taxed at 8.75% in the lower rate band, so that's up to £50,000, and because there's no national insurance due, this is why we get the tax savings as a company. And it's that saving in that band up to 50,000 that we get that saving. Over 50,000 personal income, 50,570, the dividends are taxed at 33.75%, which is still slightly lower than 40%, but it's not quite as significant between the 20% and 8.75% in the lower rate band. So one of the things to consider when you're starting a company is what happens if I have to close the company? What's involved in that? So because a company is a separate legal entity from the directors and shareholders, it has to be closed down if it's no longer required. If a company has no debt and its total assets are 25,000 or below, then it can be dissolved at Companies House via a strike-off, which is purely an administrative process. It costs £8 and takes around 3 months to complete. However, if a company has reserves, so when I say reserves, money in the bank over £25,000, then you have to employ an insolvency practitioner to carry out a members' voluntary liquidation to distribute the reserves to the shareholders. And the fees for this are at least £1,000. However, there are significant tax savings where the company has significant reserves. And so it is often worth paying those fees. If a company becomes insolvent, then it may be closed via a creditor's voluntary arrangement, a liquidation, or go into administration if it wishes to continue to trade. And these would all incur insolvency fees. So it's just worth being aware of some of the issues around closing a company before you start one, to make sure that you're aware of what the processes are. Final points. A company should not be set up without due consideration, as there are considerable administrative and legal duties. I would advise anyone who's running a business who thinks that they want to trade via a company to take professional advice before going down that route, as you will need to involve an accountant to fulfill the reporting requirements in any case. And it's better to get advice up front about, is this the right time for me to start a company? What tax savings am I going to make? The other recommendation is that for both types of structures, use technology to help you. There's lots of online systems these days that you can use, and they help you to keep records and to keep up to date with your filing requirements. And that's all I have to say on the subject today. So I hope you found that useful. But that's the end of my formal talk. So if anyone has any questions, do